All right, usually about a 15-minute presentation. Hi. I started these seminars. I just moved out to Fall Creek. We're a fee-only advisor located here. We're kind of one of the few on the north side. I'm a CPA, and we just started hosting these seminars to give a little information to the neighborhood. I hadn't really seen a lot of information given out around here. So just a quick disclaimer, none of the information presented herein is a recommendation by us or a solicitation to buy or sell securities. All this information is general in nature. You know, we don't know your personal situation, so if you don't go out and buy a bunch of stuff based on what you see in here. You know, sit with your advisor and talk about a plan that works, that's best for you. So we'll just start off. Today we're going to talk about alternative investments, what they are and why they might be good for your portfolio and why they might not be. Does anyone know what an alternative investment is? You, Christina? No? Sarita? Well, we live in Houston, so one of the most popular alternative investments, of course, is oil. It's a commodity. But there's also many other different kinds. There's hedge funds, private equity. You know, we'll go through the list. And so we're going to go through what exactly are alternative investments, why investment advisors, yes sir.
Why are they called alternative investments? Alternative to what?
So there's three traditional asset classes: cash, stocks, and bonds. Those are just the traditional ones. Anything else is classified as alternative.
Okay.
Yep. So we'll talk about why investment advisors typically recommend them, and then what you should consider before adding them to your portfolio. There's some that are good, some that are bad. And so, just like we kind of just answered, all traditional investments on page 4 are cash equivalents, stocks, and bonds. Of course, stocks represented by the S&P 500 is the biggest index to track stocks, and bonds is there's an aggregate bond index. For alternative investments, we have commodities, real estate, managed futures, which is actually a subset of hedge funds. Private equity, and then there's also other alternatives you can invest in, like collectibles, arts, stuff that I don't typically recommend. They're very illiquid, stuff like that. So we'll talk about the top 5 here. So we'll start with commodities. Now, commodity is any kind of raw material that can be bought and sold: sugar, oil, natural gas, even corn. A lot of these are listed in the Chicago Exchange.
Even if you buy it as a stock, it's still called
So you can't buy, so you're typically buying futures of commodities. So you're, just like, you work in oil and gas, just the price that's going to be in 3 months, 6 months. But you can, that's a good question. You can buy, so for gold, for example, a lot of times there's indexes that track gold, the commodity, strictly the commodity, but there's also an index that will track companies that, harvest gold and mine for gold. So that you can kind of get exposed in 2 different ways. But we'll talk about that.
Investing in like the actual company and then the actual product.
Exactly. And we'll talk about ways you can invest in each of these assets too. So for like private, but you can also invest in, there's a lot of private equity companies that are publicly listed, such as Carlyle Group is a publicly listed private equity company. And we'll talk about kind of the subtleties in that. So the next page, we'll just go right into the performance of commodities. Of course, everybody knows this. If you're in Houston, this asset class has kind of gotten drilled here in the last year. So this just shows a commodity. This is an ETF commodity, and I'll show you the benchmarks I use for these performance projections. But commodities started at, we're assuming they all start at $10,000 in January 2008, a $10,000 investment. And if you'd invested in stocks, you'd have had a $17,000 ending value. Bonds would have had 14, and commodities would have dropped. You'd have lost basically 60% of your original investment if you had invested since 08. So that, again, diversification is what we're always going to stress here. And so so we'll go into the details of commodities, kind of how you can invest. You can invest directly. You can buy, master limited partnerships, futures, stocks of companies in the industry. I work with a couple clients that have MLPs that do their taxes, and it can get a little more complicated investing directly. But there's also easier ways to get into, such as mutual funds and ETFs. The fees for the directly are always going to be lower. Mutual funds add in a higher level of fees, and ETFs add in kind of a lower level of fees on top of the direct investments. But MLPs, of course, conversely, the disadvantage is they're lower. You can't trade them as easily. It's kind of lower liquidity. You might, if you need to get money quickly, you might be in a crunch if you're invested heavily in MLPs.
Is an ETF like a bond, a gold, indexed fund or something?
Yeah, so I mean the S&P 500 index, that's an index that tracks the top 500 companies. And so the ETFs will just kind of try to mirror that index as closely as possible. They're not actively managed. They're just set by they have a set goal. They say their prospectus will say we want to invest as similar to the S&P 500 as we can, and there's no active manager kind of picking stocks. So ETFs are typically not actively managed, and mutual funds are actively managed.
Gotcha.
So and with that active management comes a higher fee. And it's shown that over time, active managers fail 80% of the time. So generally we'll always we focus on two things. I focus on two things, trying to lower taxes and your investment costs. Those are the only two things you are going to know for sure that are going to hit you. You don't know what your return is going to be. All that stuff can vary. You know you're going to get hit with high fees. You know you're going to get hit with taxes. So we try to focus on that.
I heard just recently that there are some ETFs that are coming out now that are somewhat managed.
The line's getting a little blurred. I mean, it's kind of a general statement that ETFs aren't actively managed, but you can get into, there is a subset of ETFs, a very small percentage that are more actively managed, and they do have lower fees. So it's kind of a hybrid. They're lower fees than mutual funds, and they're less actively managed, but more actively managed than the traditional ETF. So they're kind of in the middle.
How about liquidity? Is liquidity in those the same or different? Or?
For the high, it's a big range as well. A lot of ETFs are new. A lot of them are less than 10 years old. I typically wouldn't recommend anything that's been around for 5 years. And liquidity matters with that too. So if you have an ETF that started 1 to 3 years ago, your liquidity in that's going to be very kind of more sketchy than if it's been around for 10 years. So it's always good to look at kind of high volume, stuff that trades high volume, because you're going to get the same kind of exposure. So the ETFs have exploded onto the scene in the last 10 years, and there's a lot of new ones that are trying to come into play, but they're offering kind of the same, like a new S&P 500 ETF that comes in is going to be the same as like a Schwab large cap index that's been around for 10 years. Similar fees and everything. The only difference is the liquidity part. And that can cost you, if you're trying to, again, whenever you're making your trade, the price can fluctuate more heavily.
How's an ETF valued?
ETFs are valued based their NAV based on their underlying holdings. So I'm sorry, I misstated. ETFs are valued. They're traded publicly over the counter, so it's all demand. It's all supply and demand. So if Christina, wants to buy, and there's a lot more buyers, the price is going to go up. It can deviate from that NAV, from their underlying holdings. So one investment strategy actually is to try and find ETFs that are undervalued according to their NAV. If an index is vested in the S&P 500 and the intrinsic NAV value should be $50, and instead the market is pricing it at 48, that can be a buy opportunity. But that can also signal other issues that maybe the long term, like maybe that ETF might not be around as long. That can start. There's things that can move its market price away from its NAV.
NAV stands for?
Net asset value.
Net asset value.
Yeah.
So let's say I was to buy 1,000 shares in an ETF. Would they take my money and buy more of the underlying stocks, or would I be? Is there a fixed amount of shares that I'm buying into?
So they will take your money and invest it in those companies.
So they just continue to.
The assets expand, right?
Assets expand. Okay.
Yeah, exactly. So that's kind of how ETFs works. But with the highly liquid ETFs, their price variance to that NAV is minuscule, if anything. And again, I kind of that's a very rare. I haven't had that question before, because generally I recommend high volume stuff because of the price and liquidity issues, and so that the difference between the NAV is very tiny, and you're not gonna see a big deviation. But you will notice it in the shorter, if one's just started within the last few years, you'll notice it.
So if I were to sell out of an ETF, do they sell the underlying securities to pay me?
Yeah,
Okay, all right.
yeah. So that's how an ETF works.
Thank you.
No problem. So the next investment class after commodities is real estate. I think we're all probably familiar with this one. What people don't kind of think about with real estate is that it's not just raw land and houses and buildings. There's also, of course, investment properties where you can get rent, and you can also invest in mortgage companies. So, investing in a company that sells mortgages is going to very closely mirror the real estate industry. It's not going to mirror it exactly, but it's obviously has the same kind of risk as a real estate.
Is that like a REIT?
A REIT, there's different kinds of REITs. There's mortgage REITs that would invest in real estate, mortgage companies.
Okay.
Yeah, and there's also asset-based REITs which invest in houses and commercial properties and stuff like that. So the REIT is kind of more the vehicle that you're investing in the real estate.
I do have a couple alternative investments.
Yeah. And we'll kind of talk about at the end. I'll kind of try to bring it all together and kind of talk about which ones I think are easy to add to your portfolio for low cost, and ones that are more difficult, but also ones that advisors will tend to push on you because they get a higher fee from them. So real estate has performed relatively well. It's more volatile than stocks and bonds, but it's done well even since the crash. You can see it went down way, the housing market crashed in 2008, 2009. The blue line kind of went down big time, but it's surged back since then. So real estate's ended at 18, stocks 17, and bonds at 14. And so hedge funds. So what I show here is how kind of non-accredited investors can get exposure to hedge funds. So typically you have to be an accredited investor. You have to have $1 million of net worth excluding your residence, or make $200,000 if you're single, $300,000 as a family. And over and above that, that's just the minimum requirement by the regulatory bodies. The hedge fund in particular, like Ray Dalio, he'll require a huge initial investment. So yeah, you meet this minimum. You're going to come to Ray Dalio. I just hit my $1 million net worth. I'd like to invest with you. Oh, I'm sorry, we need $10 million minimum investment. So
It looked like it's really done that well anyways.
So this is why we're going to get into the difference. So for me to get into, I don't have a $10 million minimum investment. So for me to get into a hedge fund, I have to invest through mutual funds. I can't go the direct way. So this shows the indirect way of getting into mutual funds, how kind of the more common everyday people, not the top 1%, can get into this asset class. And so this is where your financial advisor will probably show you that he'll show you an index. He'll say, look, this hedge fund index is, and I'll show you it at the end, has performed, it's wildly outperforms every class. But that's because you can't get into the index investment. So for me to get into a hedge fund, I have to invest through mutual funds. I can't go the direct way. So this shows the indirect way of getting into mutual funds, how kind of the more common everyday people, not the top 1%, can get into this asset class. And so this is where your financial advisor will probably show you that he'll show you an index. He'll say, look, this hedge fund index is, and I'll show you it at the end, has performed, it's wildly outperforms every class. But that's because you can't get into the index. You have to get into it through a mutual fund. And whereas mutual funds and stocks typically have around a 0.5 to 1% expense ratio per year, ETFs will have under 0.5%. A hedge fund mutual fund is going to have 2 to 3%. So it's like 2 or 3 times what the cost.
Gotcha.
So again, these are to accredited investors, $1 million net worth. And it also allows them, all hedge funds charge like oh, awesome. Thanks. Those look good. They're going to have hedge funds, if you happen to be an accredited investor, they're able to charge a performance fee. So they're able to say, if I made you 10% this year, I get 20% of that fee, so I get an extra 2%. If you're investing in mutual funds, you're just going to have a higher, instead of the 1.5%, 75% management fee, you're going to have like 2.5%, 3%. And the same with ETFs, a higher management fee. Do you have a question?
No.
Okay. And so managed futures, I actually met with the head of Merrill Lynch up in Kingwood, actually, and I was talking to him recently about, how we were just talking investment strategies and what he was going to do because of interest rates are rising. And he said he's gotten all his clients out of bonds and he's put them into managed futures. And I was kind of surprised that he said that, and I started digging into it a little deeper, and he was screaming about, bonds are typically negatively correlated with stocks and every other asset class. They don't kind of mimic the same pattern. And managed futures do the same thing. But he was worried that because interest rates are rising, bonds are going to get hurt. But the truth is, and that's what he's pitching to his clients, to get into a higher fee that they're going to pay. So he moved everyone out of bonds, which are going to have an expense of maybe, at max 1% a year, and he moved them into managed futures, which can have as high as 3% a year. And he's just trying to get them scared about the risk standpoint. But as we saw, even in the first week of 16, rates went up in December. Bonds got hurt barely. They didn't really go down at all.
And then the market tanked.
And then the market.
Yeah, I was worried because I do have some in bonds that I've had there for a while. So anyways, I guess you never know how things are going to play out.
There can be another thing that's happened, or war is kind of on the horizon. If that happens, that can change the whole picture really quick. And what typically always happens with interest rates is people get scared and they overestimate the degree of that it's going to rise. They overestimate that it's going to rise too quickly. Bond prices get hurt initially, and then over the next couple years, they kind of outperform their historical average because that curve kind of just flattens out a little bit. And that's what the Fed said. That's why the Fed comes out and says, we're not going to raise interest rates crazily. We're trying to not kill bond portfolios. Baby boomers and everyone, a lot of people are invested in bonds. We're not just going to kill that whole asset class. So they're going to go really, they did 1/4%. They're going to maybe do another 1/4 to 0.5% this year. People are thinking it's going to go back up to where, our mortgages, we're getting into 8 and 9%, interest rates. That's not likely for the near term. So managed future is a subset of hedge funds. If we're going back into managed futures, where they basically just invest in strictly future options, swaps, and foreign exchange contracts. So whereas hedge funds will typically do leverage and invest in however they want and millions of different strategies, managed futures are very specific in that they're getting into options and futures and stuff like that. There's been many lawsuits here recently over the excessive fees charged by these investments. So if you have someone pitching to you managed futures, it's best, I was just talking to a guy trying to get him to switch over. He was in a managed future fund that had 8% per year fee, and it was actually when I looked it up, it was one of the ones that his advisor had been sued over it before. So for him to still be in it was kind of amazing.
I've never heard of an 8% fee.
Yeah, I hadn't either until I looked that one up. Managed futures, as you can see, because of the high fees, they're certainly negatively correlated to stocks, but that's because they haven't done anything. Stocks have gone up. Again, $17,000 ending value, managed futures, $9,000 ending value.
This looks like a case for traditional investments pretty much through the whole thing, other than real estate.
So the last kind of, and commodities. And what I would say was that with the last three, ETFs are still kind of new. As we kind of talked about, they're coming out with a lot more. Once the ETFs kind of go into this and lower the fees associated with these kind of investments, then it might be a good time. But now, probably not. You're just going to get hit with high fees and you're going to give away some of that return.
Yeah, it's a good time to maybe get into commodities, right?
It's cheap right now, but the question is whether your expectation is for them to go, way back up. Okay. A lot of people think the environment itself has changed, and Over the next, I think it's still going to be hard for the near term for sure, for the next 2 years. So if you're investing, I would think you'd need to have a long term, like kind of 5 to 10 year minimum time horizon to get in commodities.
Okay.
So for managed futures, again, for mutual funds, I've seen the fees range from 2 to 8% per year, and for ETFs, they go up to 2% a year, which is still high. I would say anything above 1%, you're paying too much. Is kind of how I would look at it. Private equity. I worked at a private equity company prior to branching off on my own 3 years ago. Dale, Academy, Toys R Us, these are all private equity owned companies. And these are an asset class that they just invest in equity and debt within companies. Companies that go private, privately owned companies are private equity. Unless they're owned by a family, There's some companies that are strictly still family owned. So these are not publicly traded.
Toys R Us is not publicly traded, huh?
I think it was 2011, they went back into the private sector. They were publicly traded, and then that's what will happen too. The stock price will be struggling. All these private equity companies like Carlyle Group will see that price and they'll say, this creates a buying opportunity. We like the long-term prospects for Toys R Us. Let's buy all their stock, take them private, delist them, and 5 years. So their typical time frame is 5 to 7 years. They'll try to turn the company around, and then they're going to either sell it to another private equity company or list it again.
This is a lot like betting, really.
Yes, and that exactly. And so this is kind of what I talk to some people that I just want the highest return possible, for the next 5 years. I don't care about anything else. That's more gambling. That's not sound planning.
Okay.
And I would say high net worth people have that luxury. When they're investing in private equity, even though they're investing $5 or $10 million of their total net worth and of their total assets, that's a gamble. That's like 5 to 10%. So that's a little different. Whereas if we ever had that kind of high net worth, that'd be like 100% of my portfolio. And that's not as safe. Private equity, again, this is the mutual fund view of it. It gets up to only $9,000 over the last 8 years. And so again, for private equity, you have to be an accredited investor, or you can invest in mutual funds or ETFs, but those are going to have higher investment fees. So here's where we get to the end, where I kind of bring it all together. So these are kind of the 5 different alternative asset classes we talked about, as well as stocks and bonds I threw on the page. We're going to get to their return over the last 8 years, 2008, 2015.
It's page 20?
Yes.
Okay.
So stocks and real estate perform the best. And many people will be surprised to see bonds have a very nice return over that period. And the standard deviation for bonds, the kind of risk every year you're going to get, is the lowest of those 3.
Yeah, this week's bonds look pretty good.
Bonds are very strong. People are bashing bonds right now, trying to get out of them. Part of the reason for doing this presentation was to reassure some of my clients that bonds are still one of the strongest asset classes. You should not neglect them from your portfolio. Because I get a lot of calls. I've got a lot of calls over the last 6 months. We know interest rates are coming. The interest rate rise is coming. Should I get out of my bonds? No. Would never recommend that. Because and with a bond, what a lot of people don't realize too is you're going to get hit initially. But if you hold that, like if you're invested directly with bonds, whatever interest rate you're getting, if you hold it to term, if you had a 10-year bond and you hold it till the end of your term, you're going to get that interest rate. It's going to eventually match that interest rate. The price in the beginning is going to fluctuate, but eventually it's going to level out and you're going to get paid what interest rate you were expecting. And a lot of people were out of bonds too at the beginning. So bonds are always getting hurt. So when interest rates are real low, people don't like bonds because they're paying a low interest rate. But really all you're trying to do with bonds is keep up with inflation. So when bond interest rates are real low, guess what else is real low? Inflation.
Yeah.
So you're not having to beat inflation as much. So it's still a strong asset class.
Good, that's good to know.
Yeah. And so the correlation down here is a little more complex, but this is just how well an asset class is correlated to another. So with diversification, what you're trying to investment theory will tell you you're trying to lower your volatility. And a way to lower volatility is to have asset classes that are negatively correlated to one another. So if stocks go up, bonds go down, they're negatively correlated. But you can still get a positive return, obviously, from holding stocks and bonds. So a big reason why managed futures are pushed is, again, if you look in that column of managed futures, they're negatively correlated with stocks and bonds. But if you look at the bonds kind of going left to right, they're negatively correlated with every other asset class, or no correlation as well. So my argument is, why am I paying a higher fee to get in an asset class that's just going to, charge me 2% per year?
You're saying bonds give you the diversification that you need in most cases.
I do, and I'd say, and if you want further diversification, which I recommend, commodities and real estate are the other two asset classes that you can get into cheaply, and they provide good returns that are generally, obviously commodities recently have not, but they're a way to lower your risk as well, to further diversify. They're easy to get into, highly liquid. If you want to get out, you can get out. So that's the other case for. So of the asset classes listed up here, my recommendation would be to stick away, unless you're an accredited investor, from managed futures, hedge funds, and private equity. Stay with primarily in stocks and bonds, and get a little further diversification by going into commodities and real estate.
That's exactly what I've done. I'm just saying that's the advice I've gotten, but it's interesting to look at. And the commodities look pretty bad, but I guess I was looking at like how the stock market's gone down, and I have this gold fund and it's gone up exactly 3%. Whereas everything else has gone down 3%.
Oh, you're gold funded?
Yeah.
Yeah. So gold, especially if you're negative on the outlook for stocks, gold is obviously a safe haven. Mm-hmm. Gold's been hurt recently as the Fed's kind of raising interest rates.
Oh, yeah, it went way down first. Now it's come back.
Yeah, because it makes a stronger dollar. People are more optimistic that there's not a bubble in the U.S. economy, so that makes our dollar stronger, and a stronger dollar hurts gold. Mm-hmm. So.
The other kind of thing is with stocks. That's so rolled up because they're sort of like non-U.S. stocks, U.S. based stocks. emerging markets,
Yep.
blue chip, all that kind of stuff. So there's a lot rolled up there.
Yeah, so when I kind of break it down for when I'm making my investment recommendations, I actually blow stocks up into 5 kind of different asset categories: large, mid, small, international, and emerging markets. Those are the kind of large categories I break them down into. Because those are all in, if we wanted to get into the correlation of those all have different correlation. They're all positively correlated to one another. But obviously, and in a time of, I don't know, if you have a chance to catch my podcast on what happens when interest rates rise, the U.S. stock market is eventually hurt long term, but foreign equities are a better long term opportunity in a period of rising U.S. rates. Because right now in Europe, they're still getting hit. They have very low interest rates. They're still injecting tons of money into the economy. It makes investing there more attractive. So that's why foreign stocks are actually, they got beat up last year and they got beat up this first week because of China.
Yeah.
But kind of, again, if we're kind of looking,
Not bad to leave money there.
if we're looking long term, if your investment horizon is more than 5 years, there should certainly be some portion allocated toward foreign equities. This next page just shows the benchmarks and costs over the 10 years. It shows what I used. For managed futures, hedge funds, and private equity, I had to use mutual funds because there are no ETFs that have been around longer than 3 years. And for all the other ones, I was able to use ETFs. And as you can see, over 10 years, ETFs cost you virtually nothing. I mean, $114 to get in bonds and $64 to get in stocks. That's 0.06% per year. Is what I.
That's nothing, you're right.
No. So again, what I focus on is cost. So what I try to do is I look at whenever I'm trying to onboard someone and show them what I can do for them, I take their current portfolio, I look at their average cost of their portfolio. A lot of times it's over 1. My average cost for clients, so my investment management fee ranges from 0.25% to like 0.75%.
Okay.
So that in itself is lower than your typical fee-only advisor, especially the ones you're going to talk to in the Galleria. Mm-hmm. But what I'm able to do is, most of the times people have over 1%, I'm able to lower their stuff down to where their average overall investment cost, excluding my fee, is under 0.4. So I'm able to save them typically 90 to 100% of my fee is how I kind of, is my focus. And because again, there's a bunch of research on it. A lot of your other fee-only planners will push actively managed funds, and you won't actually see what you're getting charged there. But they're going to say active management outperforms. That's not the case over the long term. There are years where active management performs better, but over the long term, because if you think about it from a logic standpoint, if there was a consistent asset manager who outperformed every year, he's going to be the richest man in the world, right? He'd have all the money in the world, whereas that's not the case. 75% of the time, every asset manager fails versus their respective benchmarks. Yeah. So I kind of more move people toward ETFs and to track an index. And my value instead comes not from actively picking stocks. I know people ask me all the time, what do you think of Apple? What do you think of this individual stock? I mean, I can give you my general, looking at it, what I think, but an index is the way to go. You're going to have a lot more risk, or less risk, I should say. So that's the benchmarks and the costs. Oh, and then this page is where I show why I'm kind of against those 3 alternative asset classes. So on the top line, you'll see the annualized return of the mutual funds for hedge funds, managed futures, and private equity. As you can see, all very low. Whereas if you were an accredited investor, pretty nice returns, especially for private equity. So you can see how, fees can quickly erode your portfolio. And that's it. So the conclusion is a lot of times your advisor might recommend alternative investments such as managed futures, but a lot of times it's too costly. And you got to ask whether it's whether your advisor's working under a suitability standard or fiduciary standard. And I would say fiduciaries won't recommend those 3 asset classes. I think it goes against the fiduciary standard because it's more benefiting the advisor to get you into those 3 subset alternative asset classes versus benefiting the clients.
Gotcha. So that's the managed futures, the hedge funds, and the private equity.
Correct. And commodities and real estate investments can be added to your portfolio at very low cost, and you'll get the diversification and the reduction in risk that you're looking for pretty easily.
Very informative.
Thanks.
Good job.
Thank you.
Don't have any questions.
No questions?
No.
Any questions, sir?
Any questions?
What do you think of Apple?